Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the tower bottom pattern, a powerful reversal signal that can help you identify potential turning points in the market. If you have ever struggled to spot where a downtrend is losing steam or wondering how to catch the start of a bullish move, this pattern could be exactly what you need. So stay tuned until the end because I will not only explain how to recognize this pattern but also share a step-by-step strategy to trade it effectively and to maximize your profits. Now we start by understanding what this bullish tower pattern is, and this bullish tower pattern is a bullish reversal candlestick formation that signals the potential end of a downtrend and the beginning of an uptrend. It signifies when a downtrend should end and the beginning of an uptrend. It is a multi-candle pattern, typically consists of at least 4 candlesticks, each playing a crucial role in indicating a shift in market sentiment. So let's look at the structure of this pattern. You start by seeing the first candle. The first candle is usually a bearish candle. This pattern begins with a large bearish candle reflecting the strong selling pressure and continuation of the downtrend. Well, after the first candle, you will see intermediate candles with smaller bodies compared to the first candle. They move sideways, gaining indecision amongst sellers. They may be bullish or bearish candle, but generally indicates a consolidation. As we can see, this is the first candle in this area, followed to bullish and bearish candles moving sideways. Then the third candle is a final candle, which is a bullish candle. This pattern concludes with a large bullish candle which closes near or above the level of the initial bearish candle. That's the initial first candle. This signifies that buyers have gained control and are driving price to the upside. There are some key characteristics you also need to know, and they are the tower bottom pattern typically forms at the end of a prolonged downtrend. So it usually forms after a prolonged downtrend. Secondly, it indicates that sellers are losing momentum when buyers start to dominate. It indicates sellers are about losing their steam and buyers are about to dominate. Confirmation is stronger when the final bullish candle shows increased volume or align with a support level. So if there is an increase in volume, it indicates a stronger formation of this pattern. This is what it basically is. So let's see how we can implement this strategy and know a step-by-step process on how we can trade using the tower bottom pattern. Now, below is a step-by-step strategy to help us trade this pattern with confidence. So this is where we are going to explain this pattern. We start by first of all identifying the pattern on the chart. As we have identified this pattern on the chart, we will see a strong bearish candle marking the continuation of a bearish pressure. Then we see at least 2 or 3 sideways moving candle forming a base signaling indecision or consolidation. Then we finally see a bullish candle that closes above the base or close to the base of the bearish candle, indicating buyers are taking control. This is what you look out for at first. The second step is to confirm the reversal. To confirm the reversal, you enter when you have noticed the pattern signaling a genuine reversal. You can use volume analysis to check if the volume increased significantly during the pattern. For a higher volume, add credibility to your reversal pattern. You can also use support level. You can draw this near a support level as it strengthens the liability of this pattern. And if we can look at this area, This area is basically a previous support level in a downtrend. This is in a previous support level in a downtrend. This area is a support level, and price formed this pattern at that support level, signifying that this support level might hold price to the upside. So we can also use other indicators such as technical indicators like RSI or MACD to confirm bullish momentum. For example, an oversold RSI crosses upward can reinforce your trading decision. So if we use our RSI and we see an oversold condition, it can also add to our confluence when we see an oversold condition. And as we can look at this area, price is below the 30 in this area, signifying an oversold condition. This is further strengthening our trade setup. So once we have spotted all this confluence, we'll enter our trade. We enter our trade in the most common approach is to enter a long position at the final bullish candle. Once the bullish candle has formed, you can enter your buy position at that area. Alternatively, you can wait for a slight retracement before entering to secure a better price. You can wait for a slight retracement, but in this setup we did not see any retracement before we enter, except you want to use this red candle in this area to act as a retracement. So I will enter at the close of this bullish candle. And to protect our stop loss, you have to protect our trade, we have to place a stop loss just below the low of the entire pattern. The stop loss should be placed just below the low of the entire pattern. Then this is to help us ensure that risk is limited, and if reversal fails, the price will continue downward, helping us to take a little bit of loss. Now we have to define our profit target by taking it based on Fibonacci retracement levels, or we can take this off Fibonacci extension levels. We can take it also off previous resistance points in the market. You can mark out previous resistance points as areas for take profits in your trade. You can take your profit in this resistance point. You can even go higher to take your profit in a higher point of resistance, as the case may be. This is basically how you can take your profit. You can also use a split take profit. You can take your first profit at the nearest resistance area, then you take your second target at twice the highs of the initial bearish resistance area. You can take your take profit in bits. That means you take out partial profit in the first take profit area, then you take out your full position in the next profit area. This is how you can manage your trade effectively. You can also manage your by by using a standard risk to reward ratio of at least 1.1:2. Risk management is crucial in trading. So using a risk to reward of at least 1:2 will ensure that your potential reward outweighs your risk. You also have to adjust your position size based on your account size and tolerance for risks. This is how you can manage your trade. So let's look for another example to better understand this pattern. Now this example is a better example because it has a retest. So when we can first spot our bearish long candle, before we spotted our side by side candle, then we saw our bullish candle that is being supported by a volume. This was supported by a volume. As you can see, the volume indicator spiked to the upside when the bullish candle was showing the signs of the reversal. So you can literally wait for a retest, and when price pulled back to that area to retest, you can enter your position in that area. Remember, your stop loss should be placed below the entire pattern area. Your take profit can be set at the next resistance point in the market, and this is how you can capitalize on your trading opportunity. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.